don't miss out that interview with Rahul Dravid coming up ahead on the show. But let's begin with a big business story of the day, which is, of course, all eyes were on the monetary policy. As expected, rates were left unchanged, and the villain of the piece is inflation. In fact, RBI Governor Shaktikanta has warned that inflation will be in uncomfortable territory and could inch higher in the quarters to come as well. Growth prospects seem to be improving. There is a nascent recovery, and the RBI's projection is that we may grow in slight positive territory in Q3 and Q4 of this financial year. If that happens, that means the recession per se would actually be over. The dampener, though, is that private investment is not so great even now, and there is always that fear of COVID numbers ramping up again. So before we begin our discussion, let's just get you an excerpt of what the governor said today, especially on inflation.
CPI inflation rose sharply to 7.3% in September and further to 7.6% in October, with some evidence that price pressures are spreading. The outlook for inflation has turned adverse relative to expectations in the last 2 months. While cereal prices may continue to soften with the bumper Kharif harvest arrivals and vegetable prices may ease with the winter crop, other food prices are likely to persist at elevated levels. Cost push pressures continue to impinge on core inflation, which could remain sticky. Taking into consideration all these factors, CPI inflation is projected at 6.8% for Q3 2021, 5.8% for Q4 2021, and 5.2 to 4.6% in H1 of 21-22.
All right, R Gandhi, former Deputy Governor of the Reserve Bank of India, on the show this evening. SK Ghosh, Group Chief Economic Advisor of State Bank of India, speaking with us, as is our very own Mythili Bhusnurmath. Welcome to all of you, and thank you for joining on the show. Mr. Ghosh, let me begin with your take on what the RBI governor has said and the picture which is now coming through. While on the face of it, there is good news. So our GDP outlook for the year has come from minus 9.5% to minus 7.5%. So we'll contract, but lesser than expected. We may even have a slight positive growth in Q3 and Q4. But are the inflation numbers and the targets there worrying?
Yeah. Good evening, Tamanna. It has been a very reasonable policy. The central bank, first of all, the central bank has actually used these explicit forward guidance route very effectively in the October policy and the December policy. You must remember that for any inflation targeting central bank, giving a clear forward guidance that rates will be on hold, liquidity will be plentiful for a sufficient period of time, as the Fed and ECB had done post the financial crisis, is a very useful tool of actually maintaining stability in the markets, and the RBI has been largely successful in doing that, because even in the face of an 12 trillion government borrowing program, the yields actually have stayed below 6%, where it should have actually moved significantly north of 7%. So having said that, I think yes, inflation remains a threat, but and there was also some concerns in the market regarding the plentiful liquidity which is sloshing in the system. But I think the RBI has taken a conscious decision that the budget actually is on 1st February and the next MPC meet is on 5th February. So the RBI actually has taken a conscious decision that growth, even though it is rebounding, is still uneven, and there may be some future wave of second round of infection. It doesn't want to rock the boat yet. So it has maintained an accommodative stance, maintained the plentiful liquidity which was available in the system. And regarding inflation, it has said that it remains a threat and it will do whatever it takes. And it also has asked the government that if we can look into some sort of the supply side management issues. But as of now, I think maintaining continuity in the policy and not rocking the boat, at least for the 1-2 months, was the motto of the central bank. They have been largely successful from that extent. So basically, if you look into the yields today, the markets today, I'm not talking about the stock market, yields today, they have maintained, they have actually declined post the policy. And this is actually very useful time also for these NBFCs. players in the market who has been able to borrow rates at unprecedented low rates. Basically, if you look at the CP rates, the treasury bill rates, that is obviously sometimes a matter of concern. But as long as it doesn't endanger financial stability to the extent that it could do, I think we might give the growth a fair chance to rebound and make it more sustained over a point of time.
Mr. Gandhi, I just want to get a sense from you on whether all of the monetary policy action or the action from the RBI that we've been seeing through these months has actually helped assuage some of the concerns. Things like credit offtake, which still continue to be low. Things like private investment, which, as the governor himself said today, is a problem. Capacity utilization still not at the best possible. There's a sense that rural India seems to be pulling us along a little better, but these kinks have not been ironed out yet. Your thoughts?
Yeah, that's right. In the sense that credit offtake is not taking place. During the financial year, since COVID started, credit has not actually had come down in between, and now it is still slightly better than March position. So there, quite a bit of expectations are definitely there, but that it is not yet picking up. But private investment not picking up, that is not a new story. It is not because of COVID that they have withdrawn. Even before COVID struck, for the past several years, 3-4 years, private investment has been dwindling down. So that way, that we cannot right now say that just because we are economies rebounding, then straight away private investment will come. So obviously it is not going to come so soon. So the heavy burden will be on the government, public sector, to bring in project and projects which will create that kind of investment demand, in addition to the consumption demand that is coming because of rural improvement and other things. So that's why I'm not very confident that private capital investment will start very soon. That is unlikely. Credit offtake is also not going to be so robust in this quarter or next quarter. So the engines will have to be definitely from fiscal spending.
Mythili, how do you look at the situation? You had an opportunity, to attend the press conference by the governor as well, one which he conducted after a long time, I must say. Is there more measures that the RBI is going to take, and the efficacy of this really? I mean, we've seen that the system is sloshing with liquidity, as Dr. Ghosh described it, but credit offtake has not really picked up on the one hand.
Well, Tamanna, you hit the nail on the head when you said what matters is the efficacy. There is no point in pumping in more and more liquidity into the system when this credit offtake is not happening, and the benefit of the liquidity infusion is yet to be seen. In fact, on the contrary, there is a very real danger that it will seep into inflation, which is already way above the RBI's target of 2 to 6%. We've been at close to 7% from almost close to 9 months. In fact, with this quarter, RBI should be getting worried about how to prepare that statement to Parliament on why it has failed to achieve the inflation target, the range of keeping the inflation within the range of 2 to 6% for 3 consecutive quarters. The RBI has taken shelter under the so-called, if I may use the word, fig leaf to say that April and May were very unusual months, so they should not be taken into consideration. But actually, if you look at the inflation numbers alone, we've had 3 successive quarters of inflation above the RBI's target range. So at a time when inflation was what was crying for attention, the RBI has chosen to look through inflation and focus on growth, where monetary policy has very limited say as far as triggering growth is concerned. We've seen over the past many months, RBI has been pushing on a string. It hasn't paid it any dividends, and at the same time, we're risking stoking inflation. So while status quo on rates as well as stance was accepted and expected, the point is that RBI lost the opportunity to tweak the policy to the extent that is necessary, precisely because monetary policy takes a long time to act. It acts with a lag of 3 to 4 quarters, by which time it might be too late. So I fear we might be going in for a reliving the days of 2008, when monetary policy remained too loose for far too long. with consequences that we are still paying for today.
Yeah, that's actually a worrying situation. I want to change tack a little bit while we talk about the monetary policy on a very important issue that the Reserve Bank of India has addressed. The governor spoke about it in his speech. They spoke about it in the press conference, and action was taken on HDFC Bank just earlier this week. Mythili, let me start with you again, because I think this was something everyone was very interested about. Digital outages and banks now being pushed to strengthen their digital infrastructure as more and more transactions take place on these online platforms. The Reserve Bank of India governor talked about a set of guidelines that they would put out. This is uncharted territory that the Apex Bank is going into.
Oh, well, yes, it is uncharted only to the extent that digital banking is still relatively new in our country. So here I'm entirely with the Reserve Bank of India in saying that you must have infrastructure that matches your business. So if your business, as in the case of HDFC Bank, is predominantly and overwhelmingly digital, then you must necessarily have the necessary technology backbone and the security of a technology backbone that does not fail you. Yes, outages perhaps with modern technology are inevitable. They can happen once in a while, but not with such frequency and not for so long. So here I think the RBI is entirely right to caution not just HDFC Bank, but in the process send a signal to the larger banking industry that yes, you first need to have the proper technology backbone, a technology backbone that does not fail you, and you have a fallback so that consumers, customers, corporates, etc. are not put in danger in the entire financial system. As in the case of HDFC Bank, there is a possibility because it is a systemically important bank. So here I'm entirely with the Reserve Bank of India in saying that the action was right. You need to have a technology that keeps pace with the pace of your growth.
Mr. Gandhi, if we look at the whole sequence of events that have taken place, one thought comes to mind is that is there enough transparency for the general public on what actually is going on? The HDFC action was brought to light because of a stock exchange notification from the bank itself, which it had to put in place. But nobody still understands what the issue is, what are these lacunae in the digital infrastructure, if any. And the worrying part is that if this is a problem with HDFC Bank, the premium private bank, and then there was the story of an outage on YONO, then what really is the level of strength of this digital infrastructure?
See, the digital capacity has a completely different take we should have. Because it is here, the speed is the essence. The funds flow in a jiffy. And because of that, when we talk about digital security, it has various ramifications, not just the assurance of completion of the transaction in due time, and not having any failure in between, and protection against frauds and other things. So the security here is not just against malpractices, it's security against failures also. So that is where the capacity planning and forward-looking infrastructure we're building up, that becomes very, very important. Yes, there is obviously all the operators are commercial entities, so they will have certainly they will look forward and accordingly build enough redundancy, but constantly it needs to be revisited because suddenly the transaction have a tendency to flare up, especially around the festival times and we have certain that kind of large surge in demand, and not just during the period, during the day also, particular period in time, the demand on the system could be very, very heavy. And here the banks also, despite all their efforts to build up their own extra capacity to meet increasing demand, they also are dependent upon outside other stakeholders, in this more specifically the telecom companies' capacity also, and the interaction and between them, and because any digital transaction hops around very many institutions, stakeholders. So that entire system has to be geared up, and that is where it is not going to be an easy task. When more and more acceptance and among the consumers of the banking services, they depend upon digital more and more, then these kind of issues we need to foresee and accordingly do something more. Your specific question about whether there is enough transparency with regard to the action or the regular supervisory or regulatory action given by the Reserve Bank against HDFC Bank. It is not that everything we needed to be completely be transparent, because first it is the in its normal course as a kind of advance instruction and to prevent future problems. Certain directions a regulator will always give to a regulated entity. It is not that right now they have a problem. That is going forward, if this kind of demand is going to be there, expansion of the business is going to be there, then certainly there is likely to be a problem. That is where Reserve Bank has kind of told HDFC Bank, go slow on it right now until you increase your capacity.
I mean, it's a rap on the knuckles, Mr. Gandhi. I mean, there's no other way to put it. It's a rap on the knuckles saying that don't expand before you fix what you're already doing. My question is that what is the purview of what the regulator can do here? We're going to see a set of guidelines for all banks in a few days, perhaps, especially on digital transactions. What are the kind of things that the regulator can oversee where it is all about technology?
Yeah, everything depends upon the demand that is coming up. More frequently, it may ask the parties to reassess their capacity for meeting the surging demand, making projection forecast about what's the kind of demand that is going to come, as that kind of stress testing to see that whether the inherent capacity and additional or rather redundant capacity is sufficient enough to meet those kind of stresses, which may ask it may ask the system audit to be done, or the Reserve Bank itself can conduct the audit. So there is several ways in which it will try to increase the approach towards sufficient additional capacity at any point in time to be available, so that the assurance of completion of the transactions to the customers is always ensured.
Dr. Ghosh, would you like to come in on this very important aspect of digital banking and what the role of the regulator is really here?
No, I think the issue has been as you know that because of the pandemic, the entire footfall has shifted from the branches to the digital side. For example, for our bank, the total number of online transactions during the pandemic times was actually more than 90%. And given the fact that we have close to 45 crores of customers. So I think at some point of time, there is also an element of system overload. You must have seen that the amount of transactions which is going through this socially inclusion programs where the government has been doing since April, the amount of money which has been transferred to Jan Dhan accounts and other accounts, that also has been humongous across all banks. Yes, it's a matter, and I think what the regulator can always ask is that the type of data, I mean, what is the number of time the system is working, or maybe the number of the transaction which is going through the digital form, what is the share in each of them. So there is always, I think, this amount of reporting could actually help. But my sense is that given the huge amount of digital shift to digital transactions, and you must remember that in the month of July also, when it was the height of pandemic, the number of loans which has gone to digital initiative on the retail side was actually the largest in the current fiscal. So while appreciating that could be some problems with the digital infrastructure, but I think this is something which the banks are also learning by doing, because we are in uncertain times, and I'm sure over a point of time, I mean, as the system progresses and as we move more towards a digital environment in terms of transaction, you all know that the UPI transaction is now at I think at record highs compared to February. So if I take all those factors into account, I think maybe it will take some amount of time for the banks to further scale up their digital infrastructure.
Well, scale up, I think, is the second part of it. The first part of it is to have a robust digital infrastructure for the existing customers in the existing base. This is not one area where customers can afford to lose faith in at all. Let's hope that there is a robust system with more transparency, I would say, going forward.